Okay, picture this. Imagine a guy. He doesn't live in some sprawling, ridiculous Manhattan penthouse overlooking Central Park. He doesn't summer in a hillside chalet in the Swiss Alps, and he absolutely does not fly on private jets. In fact, he drives an ordinary, totally average Hyundai SUV. He lives in a quiet, incredibly modest suburban home in New Jersey. To his neighbors, well, to them, he's just a deeply religious family man who spends pretty much all his weekends doing charity work. I mean, there's absolutely nothing about this guy that screams power, wealth, or influence, right? But beneath this incredibly frugal, completely invisible surface, this exact same man was quietly sitting at the control panel of a financial doomsday machine. Completely undetected by the world's absolute greatest financial watchdogs, he had systematically and secretly weaponized over $100 billion.
So let's dive right into this explainer and completely unravel the greatest, fastest single loss of personal wealth in modern financial history. We're looking at a story of just absolute extremes. It's an invisible force colliding head-on with Wall Street's insatiable greed, resulting in $20 billion literally evaporating in the span of just 48 hours. This is a wild financial thrill ride about the massive blind spots in our global markets, the unbelievable danger of unchecked leverage, and the totally devastating consequences of a hidden house of cards collapsing right before our eyes, in real time.
Part 1. The Invisible Market Whale. Pious Humility meets Wall Street Casino. To really wrap our heads around this, we have to look at the ultimate paradox of this man, who was eventually revealed to the entire world as Sungkook Bill Hwang. On one hand, he's giving millions to Christian charities, he's funding theological seminaries, he's backing homeless missions. But on the other hand, he gambled with the relentless, absolute recklessness of a Wall Street high roller.
Now, what's just staggering here is the extreme contrast between his public persona and his hidden reality. I mean, while he preached pious humility and lived several notches below his means, his hidden reality was playing out high above Central Park on the 38th floor of 888 7th Avenue. That was the home of his supposedly quiet family office, Archegos Capital Management. Through Archegos, Hwang managed a massive, invisible footprint. He became what they call a whale, Wall Street slang for an entity with such dominant market-moving power that they make waves just by existing. Yet, he never broke the surface. No regulatory filings, no public footprint, nobody even knew he was there.
And to understand the sheer scale of his success before the spectacular fall, just consider this for a second. At his absolute peak, Bill Hwang's liquid personal wealth briefly eclipsed $30 billion. Let that sink in, $30 billion. Sure, there are richer people on the Forbes list, but their wealth is locked up in massive companies, real estate empires, or sports teams. Hwang's $30 billion was virtually as liquid as the cash sitting in your checking account right now. He was quietly one of the richest men on planet Earth, and the general public, heck, even most of Wall Street, didn't even know his name.
Part 2. Weapons of Mass Leverage. Trading in the Shadows. Now, you might be wondering, you cannot secretly weaponize billions of dollars without an incredible invisibility cloak, right? US markets are heavily regulated. Buy more than 5% of a company, and everyone sees you. So how on earth did Bill Hwang build a $100 billion portfolio without leaving a single fingerprint?
Well, the crucial point is that Hwang used a brilliant but highly dangerous financial derivative known as a total return swap. Think of a swap kind of like renting a house, but with a crazy twist. You don't own the house, the bank does. But you have an agreement. If the value of that house goes up, the bank pays you the difference in cold hard cash. If the value of the house drops, you have to pay the bank the difference. You get all the financial exposure, all the thrill, all the risk, without ever officially putting your name on the deed. Because the banks were the official buyers of the stock, Hwang's identity and the gargantuan size of his bets were completely 100% hidden from regulators and the public.
Let's break this down to see why it's such a game changer. When you own stock directly, you are the owner of record. Disclosures are absolutely required. And crucially, under the Federal Reserve's Regulation T, you can generally only borrow up to 50% of the purchase price on margin. But with a swap, the bank is the official owner. Disclosures are entirely hidden, and that pesky 50% leverage limit completely vanishes. This allowed Archegos to legally bypass margin limits and stay entirely off the Securities and Exchange Commission's radar, like a ghost in the machine.
Part 3. Building the House of Cards, the 6x Escalation. Armed with these massive total return swaps, Hwang began funneling all this borrowed money into an astronomical house of cards. But what's really fascinating is how he actually invested it. You'd think a guy orchestrating a $100 billion hidden portfolio was using complex algorithmic models, quantum computing, or some obscure collateralized debt, right? Nope, he wasn't doing any of that.
He was basically investing like a retail day trader on Reddit, just on a cosmic multi-billion-dollar scale. He didn't use complex derivatives for the actual assets, he simply picked a handful of tech and media stocks. He loved companies benefiting from trends like cord cutting and online shopping. He poured absolute billions into American media giants like Viacom, CBS, and Discovery, alongside massive Chinese tech companies like Baidu and VipShop. He built a highly concentrated portfolio, literally betting the entire house on just a few names, using old-school, fundamental gut-feeling analysis.
But here's the thing, extreme conviction is deadly when combined with extreme leverage. Initially, Archegos used standard hedge fund leverage, borrowing maybe $2 for every dollar they had. Cool, but by late March 2021, Hwang was leveraging his portfolio up to 6 times. To put that completely unhinged number into perspective, for every $20 million he actually had, he was borrowing roughly $85 million. He was throwing down $100, but only keeping $5 in his pocket as a safety buffer. If the market turned against him even slightly, that tiny buffer would be incinerated instantly.
And this right here is where the massive systemic flaw of Wall Street comes into play, the blind lenders. To pull this whole shebang off, Hwang didn't just use one bank. Oh no, he went to the absolute biggest prime brokers in the world: Morgan Stanley, Goldman Sachs, Credit Suisse, Nomura, UBS. And because of the stealthy nature of those swaps we talked about, none of these banks could see his total exposure. They only saw their own little vertical slice of his portfolio. Morgan Stanley was blindly lending him billions to buy Viacom CBS, completely, blissfully unaware that he was making the exact same massively leveraged bet on Viacom CBS across the street with Goldman Sachs, and again at Credit Suisse.
Part 4. The Margin Call Avalanche. The Liquidity Tsunami hits. So, the tension finally snaps during the week of March 22, 2021. Hwang is sitting on tens of billions in concentrated, highly leveraged bets spread across all these blind banks. And as you know with avalanches, all it takes is a single pebble to bring the whole mountain down.
Trace this rapid-fire, 48-hour death spiral with me to really feel the sheer panic. It all begins on a Monday afternoon. Viacom CBS suddenly announces a $3 billion stock sale to fund their new streaming service, while investors absolutely hate the dilution. By Tuesday, the stock drops 9%. On Wednesday, the bottom falls out and it plummets 23%. Because Hwang is leveraged 6-to-1, that drop instantly, violently vaporizes his tiny margin buffers. The banks demand cash immediately, a margin call. By Thursday, other stocks in his portfolio, like Tencent Music, start plummeting too. Margin calls swell into the billions. Hwang's executives call the banks and say the terrifying words, "We can't pay." Panicked prime brokers hold emergency meetings, literally begging Hwang to sell shares to survive. And incredibly, he stubbornly refuses.
Part 5. Wall Street's billions vaporized. The aftermath of the fire sale. When Friday morning hits, all the pleasantries are gone. It's every bank for themselves. When Archegos officially defaults, the prime brokers suddenly realize they are holding billions in highly inflated stock that is about to crash. And the golden, unwritten rule of Wall Street is, if you have to panic, panic first.
Morgan Stanley and Goldman Sachs quietly and aggressively dumped their shares in a ruthless fire sale, sprinting for the exits and escaping mostly unscathed. But not everyone made it out before the heavy steel door slammed shut. Look at this systemic damage. Credit Suisse took a mind-boggling $5.5 billion hit from this single client. Japan's Nomura lost $2.85 billion. Even Morgan Stanley, who moved fast, still bled nearly $1 billion. In total, over $10 billion of bank money was torched in an instant, and Bill Hwang's entire $20 billion fortune wiped from the face of the earth. Poof, gone.
So you have to ask, how could the smartest, most well-resourced financial institutions on Earth let this happen? Following the disaster, Credit Suisse commissioned a massive independent review. I'm talking an agonizing investigation. They painstakingly reviewed over 10 million documents and conducted 80 in-depth interviews to find out exactly what went wrong. And the findings? They were devastating. As it turns out, this wasn't some unpredictable computer glitch or a crazy system failure. The bank's risk systems actually worked perfectly. They lit up like a Christmas tree, identifying the acute, massive dangers of Hwang's concentrated, under-margined portfolio. But the official report revealed a complete, spectacular failure by the human business executives. Chasing tens of millions of dollars in juicy fees, they systematically ignored the blaring red flags, failed to effectively manage risk, and basically traded catastrophic global exposure for short-term profit.
Part 6. The ultimate price paid. 18 years for a $20 billion mistake. So what exactly is the final cost of completely destroying $20 billion and totally destabilizing the global banking sector? Because let's be real, in high finance, massive losses are pretty common, but criminal accountability, that's exceedingly rare. But this time, the sheer scale of the deception simply could not be swept under the rug.
The hammer fell hard. In November 2024, Bill Hwang was sentenced to 18 years in federal prison for market manipulation, securities fraud, and wire fraud. For a white-collar financial crime, an 18-year sentence is exceptionally, unusually harsh. It reflects the terrifying reality that one man's completely hidden gambles very nearly brought down major pillars of the global economy.
During the sentencing, prosecutor Andrew Thomas delivered this really chilling statement. He said, "It stands among a rare class of cases that truly could be described as a national calamity. Absolutely brutal. But you want to know the truly terrifying part? The real twist? While Europe actually went ahead and updated the rules to demand transparency on who bears the economic risk of these swaps, the United States has still not closed these loopholes. The US still lacks the aggressive transparency regulations required to expose these invisible whales before they breach."
Which brings us to the most unsettling question of all. If the exact same derivative loopholes that Bill Hwang used to secretly build a $100 billion financial bomb remain largely intact in the US markets today, who is quietly building the next explosive house of cards right now? Are they already out there swimming just beneath the surface, driving a modest car, waiting for the next avalanche? I leave you with that thrilling and frankly terrifying thought to ponder. Thanks for joining me on this explainer, and keep your eyes on the shadows of the market.